Hello everyone, and welcome back to Collin Investing. I am Collin, and this channel is your go-to resource for navigating the complex and often turbulent world of finance and investment. We're here to break down key trends, analyze market movers, and provide you with the insights you need to make informed decisions. Whether you are a seasoned investor or just starting your financial journey, our goal is to provide clear, concise, and actionable information. We'll be covering everything from global economic shifts to in-depth stock analyses, all with the aim of helping you understand the forces shaping your financial future. So let us start with some of the hottest topics this year. So, in the last section, I gave a brief overview of what we will be talking about. Now, let's dive into one of the most significant stories shaping the global economic landscape: China's 2025 manufacturing push. This isn't just another headline, it's a pivotal moment. 2025 is a reporting year for the Made in China 2025 initiative, a hugely ambitious plan launched a decade ago to transform China into a high-tech manufacturing powerhouse. Think about it, we're talking about major advancement across the board: artificial intelligence, robotics, aerospace, new energy vehicles. These are all areas where China is making significant strides, and this progress isn't happening in a vacuum. It is also a direct response to increasing global pressures and competition, particularly from the United States. We will get deep into that later. What I want to say is that the competition makes things complicated. For example, one interesting point to this: you might have even seen a recent BBC report offering surprisingly, and I mean surprisingly, positive coverage of China's manufacturing rise. It is unusual, you know. Usually there is always "but" to balance the report. Maybe there are other factors there, but that is worth noticing. In summary, 2025 is the reporting year. AI, robotics, aerospace, and new energy vehicles are seeing huge growth. And also, it's worth noting that a traditionally critical media, BBC, reports it with a surprisingly positive view. Building on China's manufacturing push, we inevitably arrive at the complex web of geotensions and strategies that define its relationship with the world, and particularly with the United States. For years, China pursued a strategy known as 韬光养晦, or 韬光养晦. It is a strategy. In essence, it means hide your strength, bide your time. It was a low-end profile approach, focusing on internal development and avoiding direct confrontation. However, in recent years, especially in reporting year, we have seen a shift. The dynamic between US and China relations has become increasingly characterized by competition, and sometimes by open confrontation. We've seen sanctions impose strategic responses from both sides. The US sees China's growth as a threat. You might be wondering, what tools does China have at its disposal in this high-gen stakes game? Well, one lever has been rare earth supply. China dominates the production of these critical minerals, essential for many high-gen tech industries. Then there are economic sanctions, targeting companies operating within China. Another potential tactic is currency devaluation, making Chinese exports cheaper. Although this comes with some risk. But, and this is a critical but, all of these countermeasures have limitations. The effectiveness of rare earth restrictions is diminishing as other countries diversify their supply chains. And drastic measures like massive currency devaluation could destabilize China's own economy and hamper efforts at internationalizing the yuan. Hit on a delicate balancing act, and the consequences of missteps can be significant, not just for China and the US, but for the entire global economy. We, as people living in the economic world, have to keep an eye on those. Now, the US-Ukraine dynamic isn't the only game in town. This leads us to an interesting paradox and an often overlooked piece of the puzzle: the role of Russia, and more broadly, the shifting sands of global alliances. The Russia-Ukraine conflict has undoubtedly cast a long shadow, influencing China's strategic planning in several ways. Consider a situation where there are potential negotiations and maybe even agreements between Russia and a future US administration, particularly under Trump. This isn't just speculation. There are analysts who are actively considering various forms of cooperation between Russia and US. We are talking about trade and international relationship. You might be thinking, where does this leave China? Well, it puts even more emphasis on its relationships with countries that haven't imposed sanctions on Russia. India, for example, becomes an even more crucial trading partner. It's like a global chessboard, and every move has ripple effects, and that's where the complex dynamics of global alliance comes into play. Remember that key concept we discussed? It shows. The alliances are not fixed, interests are constantly evolving, and nations are continually reassessing their positions. It will become one of the hottest financial topics this year. With that in mind, let's examine the broader context of global economic competition. It's important to remember that the United States isn't just a single country. It operates as a global empire supported by a vast network of allies. This isn't just about military might. It's about economic influence and interconnectedness. Now, you might be wondering, why are so many developed nations seemingly wary of China's rise? It is related to one of the previous points, 2025 reporting year. The answer in a word is competition. Imagine that you are one of the developed countries. China's rapid economic growth, particularly in key industries, directly threatens established players in those same sectors. It's a simple case of a shrinking pie. Let's take shipbuilding, for instance. China's ascent in this industry has put immense pressure on traditional shipbuilding powerhouses like South Korea. Or consider high-speed rail, once dominated by companies like France's Alstom and Japan's Shinkansen. Chinese firms are now aggressively competing for, and often winning, international contracts. And then there's the drone market, where DJI, a Chinese company, has essentially established a near monopoly in the consumer segment. These are not isolated incidents. They're examples of a broader pattern. As Chinese companies become more competitive, often backed by state support, they disrupt existing markets, forcing established players to adapt or, in some cases, decline. I was talking to a CEO last week, and he said that it's not about not able to compete, it's about how fast they can change. However, that's not the whole story, though. While China is flexing its economic muscles on the global stage, it's also grappling with significant internal challenges. The real estate sector is facing considerable headwinds. Unemployment is a persistent concern, and economic pressures are mounting. It's a paradox. A nation projecting strength outward while simultaneously dealing with vulnerabilities at home. So the growth is a double-edged sword. So we've seen the broad strokes of the global economic landscape, but that's not the whole story. Let's shift gears and dive into the specifics of individual companies, because sometimes the best way to understand macro trends is to see how they play out on a micro level, and that's where Palantir Technologies, ticker symbol PLTR, comes in. Now, this company has been on an absolute tear. The stock has surged, driven by some seriously strong financial performance. I mean, we are talking about numbers, but it is good to look at those numbers closely. Let's break down their Q4 2023 results. We're talking about revenue exceeding expectations, earnings per share beating estimates, and future guidance that frankly has the market buzzing. The word itself is not important. It is the trend that matters. A lot of things are driving Palantir's growth, but one factor stands head and shoulders above the rest. Artificial intelligence. Palantir's AI-powered platforms are in high demand, particularly from government clients. This isn't just about fancy algorithms, it's about real-world applications, providing solutions in areas from defense to data analysis. And don't forget there is a potential election. But, and here is the but, every investor needs to consider, there are valuation concerns. Palantir is trading at a high P ratio, which is a measure of its price relative to its growth. To put it simply, it's expensive. And this raises the question, is the current price justified, or is there a potential for a correction down the line? So, what's the takeaway for investors? Well, in my years of analyzing market, my recommendation, especially for long-term investors, is to approach with caution. The company is great, it's just that the price needs to be great too. Palantir is a phenomenal company with a bright future, but at these levels it might be prudent to wait for a more attractive entry point. It's about balancing excitement with a healthy dose of realism. We will see the earning, and if it beats the estimate again, then it may be a good time to buy it. Building on that point about Palantir, another company experiencing a bit of a roller coaster ride lately is Tesla, ticker symbol TSLA. We've seen a significant pullback in the stock price, and you might be wondering what's going on. There are many reasons, but sometimes it is just market doing its thing. Sometimes, pulling back is reasonable after a period of growth. Well, there are always narratives, and you'll hear all sorts of explanations. Everything from concerns about competition to Elon Musk's, but as say, varied public pronouncements. But I will give you some concrete level. Let's look at the technical analysis. There are key support levels to watch, around $330, and then a further potential support at $270. These are price points where, historically, buyers have stepped in. Now, what does this mean for a long-term investment strategy? Remember that key concept from a previous slide. Well, it plays directly into. It's all about perspective. For some, this pullback might represent a buying opportunity. If you believe in Tesla's long-term vision, a dip like this could be a chance to acquire shares at a more, shall we say, palatable price. But, and this is a big, but it's crucial to acknowledge the inherent volatility of Tesla's stock news. And let's be honest, sentiment to play a huge role in its price swings. So, this isn't for the faint of heart. It requires a strong stomach and a clear understanding of your own risk tolerance. Just like what I said in Palantir, it is about balancing excitement with a healthy dose of realism. My position is that if you are not comfortable with volatility, do not even look at it. Let's turn our attention to another interesting stock, Arista Networks, or ANIT. Now we are talking about numbers, calculations, and valuations, based on my calculation. The intrinsic value of Arista Networks stock comes in at around $71 per share. Compare that to its current trading price, which is hovering around $109. Just for a reminder, intrinsic value means the true value of the company. The calculation takes several future assumptions into consideration. So what does this difference, this pretty sizable gap, tell us? I will tell you what it tells. It suggests that, at least according to this discounted cash flow model, the stock might be overvalued. The assumption may be wrong, but it is good to be aware of the assumption. It is a common method to check if a stock is valued too high or too low. It all comes down to assumptions about the future. We're looking at a free cash flow forecast that projects growth, and that growth rate is essential. How fast will Arista Networks' free cash flow increase over the next few years and beyond? We are taking assumptions from analysts then. Here is the discount rate. It is critical, to be honest. This reflects the risk associated with the investment, and it takes into account things like the company's capital structure, how much debt versus equity it's using. For those less familiar with company structures, it affects how the risk is evaluated. In the case of Arista Networks, the calculation is considering zero debt. The point is all of those factors feed into this intrinsic value calculation. And the result? Well, it suggests that the market might be a bit, shall we say, optimistic about Arista Networks' prospects. That's not to say it's a bad company. Not at all. It simply means that based on these numbers, the price might be running ahead of the underlying fundamentals. It means we have to be cautious about it. But, as always, remember this is just one piece of the puzzle, one perspective based on one model. Still, it's a valuable data point to consider, especially in the context of everything else we've discussed today. Now, let's dive into another intriguing case study, AstraZeneca, ticker symbol AZN. This one presents a fascinating valuation puzzle, and it highlights the importance of, shall we say, questioning the numbers. I performed an intrinsic value calculation, and you might think, another one? Yes, it is useful, especially for this case. We will see why it is important. Initially, I got a significantly higher intrinsic value, suggesting a massive undervaluation. But then the question comes, why is that? But I noticed something crucial. AstraZeneca has an incredibly low beta, 0.18. Now, for those less familiar with beta, it is how volatile the stock is. The lower the beta, the less volatile it is, supposedly. Remember how we talked about how beta affect the discounted rate? It affects this. It drastically reduces the discount rate used in the valuation, and the lower beta itself is questionable. Think about it. You can get over 5% return from some government bonds, and that is the risk-free rate. And we are talking about 0.18, which is a very, very low number. It is a healthcare company and is less correlated to economic ups and downs, but still, it's exceptionally low. So, to test the sensitivity of this valuation, I ran a couple of what-if scenarios. I adjusted the beta upwards. First, I bumped it up to 0.5, which is still quite conservative for most companies. Then, I went further, setting the beta to 1. It is average, meaning average risk. Even with these adjusted and arguably more realistic beta values, the intrinsic value still came out higher than the current market price. What's the takeaway here? Even after accounting for this potential distortion, AstraZeneca still appears to be undervalued, according to these calculations. It's a compelling situation, and it reinforces a critical point. Always dig deeper, challenge the assumptions, and consider multiple perspectives when evaluating a stock. It tells you that the stock is still undervalued. Even if we take the most conservative measure, we need to keep an eye on that. Let's shift our focus to a fascinating, and frankly rather risky, corner of the AI market. We're going to do a head-to-head comparison of two companies, SoundHound AI, ticker symbol Sound, and BigBear.ai, ticker symbol BBAI. Now these two stocks have been on wildly different trajectories in 2025. BigBear.ai has been soaring, while SoundHound AI has, well, let's just say it's been having a rough time. especially after some recent news about Nvidia. But that news is less important. For us, the important thing is that the direction and the numbers of the two, which one of them are more stable, but which one, if either, is actually worth considering for a long-term investor. It is the real question. Let's dig into the numbers. We'll start with revenue. On a trailing 12-month basis, BigBear.ai is generating more revenue, $155 million, versus SoundHound's $67 million. However, SoundHound appears to be growing faster. I am saying appears because it is important. But, and this is a crucial but a significant portion of SoundHound's growth is coming from acquisitions. It's inorganic growth, which in my opinion isn't as valuable as organic growth driven by core business strength. It is not about the core business of SoundHound AI growing faster. When we look at profitability, or rather the lack thereof, the picture gets even murkier. Both companies are losing money, and a lot of it. BigBear.ai is sporting a negative 29% operating profit margin. SoundHound, a staggering negative 140%. Ouch! SoundHound's management claims that once they fully digest their recent acquisitions, margins will improve. But, as they say, the proof is in the pudding. We'll have to see it to believe it. Cash flow tells a similar story. BigBear.ai is negative, but SoundHound is, well, let's just say it's significantly worse. And then here's the debt. BigBear.ai has a substantial amount of long-term debt, but it also has higher revenue to potentially service that debt. SoundHound has less debt, but also less cash flow. It's a precarious situation for both. So, what about valuation? Well, I ran discounted cash flow models for both companies. Remember, we talked about intrinsic value? It applies here too, and frankly, both came out looking overvalued, with their current market prices significantly higher than my calculated intrinsic values. Much of this is driven by their high betas, reflecting their inherent riskiness. To emphasize the riskiness, their future is not certain, and they may lose a lot of money. Another way to look at it is the forward price to sales ratio. And here SoundHound is trading at a much higher multiple than BigBear.ai, suggesting it's significantly more expensive relative to its projected sales. So, here's my conclusion, and it's not a ringing endorsement for either company. I wouldn't personally invest in either of these stocks right now. They're both too risky, too overvalued in my view. However, if I were forced to choose, if someone put a gun to my head, I'd slightly lean towards BigBear.ai. It's the lesser of two evils, so to speak. But please remember, this is not investment advice. Do your own research and understand the very real risks involved before even considering these kinds of speculative investments. We just talked about two risky stocks. Now let's talk about a more stable and positive stock. Let's switch gears and look at a company that's been making some seriously smart moves. Roku, ticker, symbol, OQ. I have talked about this for some time now. After the market closed on the 13th of February, 2025, Roku reported its quarterly financial results, and, well, the stock price took off like a rocket. I mean, it jumped double-digit. It is great now. I've been bullish on Roku for a while, recommending it as a buy, and I'm feeling pretty good about that call right now. But let's not get ahead of ourselves. Let's break down why the market is so excited, and more importantly, whether that excitement is still justified. First, the numbers. Roku added a whopping 4.4 million new streaming households in the last quarter. That's a significant acceleration compared to previous quarters. They now boast nearly 90 million streaming households. It is a huge number, and it's not just about the quantity of users. It's also about how much those users are spending. Average revenue per user, or ARPU, also increased by a healthy 4%. But here's where things get really interesting. Roku isn't just a software company anymore. They're now designing and manufacturing their own TVs, and this is a big deal. In 2024, their first full year of selling these TVs, they moved over 1 million units. I think it is very successful. You might be thinking, why would a software company get into the hardware business? Well, it's all about controlling the ecosystem. By making their own TVs, Roku can ensure a seamless user experience, and, crucially, they can capture a larger slice of the advertising revenue pie. And it's not just about selling TVs, it's about where they're selling them. Roku has secured partnerships with some of the biggest retailers on the planet: Walmart, Amazon, Target, Best Buy. These are heavy hitters, and their willingness to partner with Roku speaks volumes about the quality of their product and the strength of their brand. I mean, getting those is not easy, and it shows Roku is really good at what they do. So what's my verdict? I've been saying buy before, and I'm reiterating that recommendation now. Even after this recent price jump, I still believe Roku is a compelling long-term investment. Company is executing its strategy flawlessly, expanding its reach and solidifying its position as a leader in the streaming wars. I am confident to recommend it as a buy. We just talked about how great Roku is as a growth stock. Now let's wrap up with a very different but equally compelling investment idea. A dividend, which is income. I'm talking about McDonald's, ticker symbol MCD. Yes, the golden arches themselves. You might not think of McDonald's as a hot stock pick, but hear me out. This is a company that has consistently rewarded shareholders with increasing dividends, and it offers a fascinating case study in how a mature business can still deliver value. Let's start with the dividend. Over the past decade, McDonald's has more than doubled its dividend per share. Imagine that. If you had invested 10 years ago, your income stream from this one stock would have more than doubled. But it's not just about the dividend. McDonald's has been quietly, but effectively, transforming itself. We're talking about revenue growth, driven by digital initiatives, things like mobile ordering, delivery, and loyalty programs. These aren't just flashy add-ons, they're fundamentally changing how people interact with the brand and driving more frequent visits. And this is translating into some seriously impressive profit margin expansion. One of the key to McDonald's success is its franchise business model. They don't own most of their restaurants, they franchise them out. This means lower operating costs, higher profit margins, and a more predictable stream of royalty income. It's a beautiful thing, really. I mean, think about how many stores they have. Imagine that they own all the store. How much does that cost? So it's a great business, and it's attractive for franchises to operate McDonald's restaurants, and especially more attractive now with the food delivery options and the increased digital options. If more customers are ordering through McDonald's app, that's less pressure on each location for labor. So, what about valuation? Well, I ran a discounted cash flow model, and it suggests that McDonald's is currently undervalued. Its intrinsic value is more than the current market price, and when you look at its forward price to earnings ratio, it's trading at a reasonable level, especially considering the stability and predictability of its business. So here's my final take. McDonald's is an undervalued dividend stock that offers a compelling combination of income, growth, and stability. It might not be the most exciting name in the market, but for long-term investors seeking a reliable source of income and potential capital appreciation, it's definitely worth a closer look. So consider adding it to your portfolio. And that brings us to the close of today's deep dive into the markets. We've covered a lot of ground, from global economic shifts and geotensions to the specific ups and downs of individual stocks. I hope you found it to be not just informative but engaging. Remember, the world of finance and investment is constantly evolving. It's a living, breathing thing, full of interconnected forces and surprising twists. So the best thing you can do is stay informed, stay curious, and keep asking questions. And that's where, hopefully, we come in. If you enjoyed this video, and I sincerely hope you did, please take a moment to show your support. Give it a like, and even more importantly, subscribe to Collin Investing. It's a simple click, but it makes a huge difference to a growing channel like this. It allows me to continue, but more than that, I genuinely want to hear from you. Share your thoughts, your questions, your insights in the comments below. What resonated with you? What left you scratching your head? What other topics or specific stocks would you like to see us cover in future videos? This isn't a one-way street, it's a conversation. We're building a community here, a place where we can all learn and grow together. So, join the community, become a part of the conversation, and, most importantly, stay informed. The more you know, the better equipped you'll be to navigate the complexities of the financial world and make the decisions that are right for you. Thank you so much for your time, your attention, and your engagement. We'll be back soon with more insights, analysis, and, hopefully, some answers to your burning questions. Until then, take care, and happy investing.